Hi, everyone. In this recording, I will present the 2005 Journal of Finance article titled The Value Premium. In terms of methodology, in my opinion, this is the first article that provides a real business cycle style model for the cross-section of returns. In terms of substance, this paper provides a scientific explanation, in other words, a causal mechanism for the value premium. The mechanism is based on costly reversibility and time-varying price of risk. In particular, costly reversibility and the countercyclical price of risk cause assets in place to be harder to reduce and hence are riskier than growth options, especially in bad times when the price of risk is high. The mechanism has two components. First, costly reversibility or asymmetry in capital adjustment costs causes countercyclical value minus growth risk. The second component is that the countercyclical price of risk reinforces and propagates the symmetry mechanism so as to generate enhanced risk dynamics. Now, why would the symmetry give rise to countercyclical value minus growth risk? It turns out in a production economy, adjustment cost leads to higher amount of risk. And this is an economic insight based on Urban's 1998 Journal of Monetary Economics article. So this is the reason that Urban shows that why it is so difficult to explain equity premium puzzle in a production economy than in an endowment economy. Because by adjusting capital through capital investment, firms can smooth dividend streams so that the cash flows or dividends or net payouts do not co-vary much with economic downturns. Now, by its very nature, adjustment cost is the offsetting force of adjusting capital. Okay? As a result, dividends become more volatile and co-vary more with economic downturns, and therefore generating higher amount of risk. And that was the economic insight highlighted in Urban's 98 GME article. So I'm going to apply this economic mechanism in the cross-section to show that value stocks are going to be more sensitive to economic downturns than growth stocks. More specifically, I demonstrate the economic linkage between value and the risk across booms and recessions. In particular, in bad times, value stocks are burdened with more unproductive capital stocks. Value stocks are more unprofitable. They're burdened with more unproductive capital, and they would like to cut more capital or disinvest. However, they run up against steeper capital adjustment costs associated with disinvestment. So therefore, these value stocks are stuck with unproductive capital, and therefore their cash flows co-vary more with economic downturns, and thereby giving rise to a higher amount of risk. Whereas in good times, growth firms have more productive capital. They would like to expand more. They are the ones who face higher amount of adjustment costs, even though the adjustment costs are not as high as disinvestment costs, but they're still positive. So, and therefore, growth firms face higher level of adjustment costs in good times. They are the ones who have a higher amount of risk in good times. On net, however, because of time-varying price of risk is higher in recessions than in booms. So the countercyclical value minus growth risk is going to counteract, is going to be multiplied, amplified, magnified by the higher amount of price of risk in recessions, thereby generating a higher amount of value premium. There's another layer of economic mechanism that is the countercyclical price of risk. It's going to make value firms want to cut even more capital because the discount rate is high or discount factor is low in bad times, and therefore the disinvestment incentives for value firms are going to be even stronger than the case with constant price of risk. So this table is a brief citation analysis. Now, citation is not everything. Nevertheless, citation is an objective metric that is relatively free from any manipulations or whatnot. So it's objective, albeit with different kinds of caveats. So GS stands for Google Scholar. Web of Science is denoted right here. WS stands for Web of Science. This is, I did the search 2 days ago. This is as of June 13th, 2021. And the Y is the number of publication, number of years since publication. So a little bit of history. So this was shortly after Pharma French in 1993 and 1996 that make the value factor extremely popular. And then one of the more important questions facing asset pricing theory is really what explains the value premium. Okay, so the paper by Bergery and Nike is really the one that launched the whole literature that with fully specified dynamic investment models that try to understand the value premium, as well as later on many other anomalies like momentum, for example. So, and Bergery and Nike, as one can see from the table, Bergery and Nike continue to be our intellectual leader, and from whom we draw our intellectual aspiration and inspiration as well. However, so my thesis has done well also, especially in terms of citations, number of citations per year. And that's been more than 15 years since publication for most of these articles. So this table provides a little bit of a time test. So more evidence. This is my Google Scholar page. The value premium paper is my second most cited paper. 1604 is the total number of Google Scholar sites as of June 13, 2021. It's given right here, 1604. So Web of Science, so also dated 2 days ago, June 13th, this year. So the total number of Web of Science citations is 462 as reported in this table, in the prior table. Okay, so the paper won the Smith-Bridham Prize for best paper on investments for 2005, along with Carlson Fisher and Jim Marino paper in the same area. So the value premium paper has also been featured in Bodick and Marcus's Investments, which is the standard textbooks. Standard textbook we use for investments for MBA students. So, so they have been doing so since 2007, I believe was the 7th edition. So in the latest edition, 12th edition published this year in figure 13.3. So this is a figure based on one of our tables in Petkova and Zhang 2005 GFE article. So that shows that HML beta, this is the market beta for the value premium, is different in different economic states. In particular, value premium is riskier, or value is riskier than growth, especially in bad times when the expected market risk premium is the highest. Okay, so in Petkova and Zhang 2005, so we sort different periods into different economic states based on their estimated values for expected market risk premium, right? So we characterize the states with the highest values of expected equity premium to be the trial, business cycle trial. That's the, in a sense, the worst times. It turns out the value is particularly riskier than growth during those periods, whereas in peaks, business cycle peaks during which the market risk premium, expected market risk premium values were the lowest. It turns out growth is riskier than value. So I should issue a caveat that that the evidence on betas is not as reliable as one would like, especially when dealing with firm level variables. This is why later on I've turned my attention to like investment and profitability, and don't bother much with different versions of beta. So there's a deeper philosophical thinking behind it, but hopefully I will be able to explain that in a future presentation. So here is the paragraph in Bodick and Marcus's discussion, and the whole paragraph basically describes the causal mechanism that I came up with in my thesis for the value premium, a combination of costly reversibility and the counter-cyclical price of risk. So here's the outline for the presentation. I will first describe the economic model, then talk about the quantitative results, and then dive a little bit deeper into the causal mechanism. And then I'm going to highlight the issue about the failure of the CAPM in explaining the value premium. This has been a focal issue that has given rise to a large body of subsequent literature. So, and then I'm going to talk about the recent performance of the value premium. Especially, I'm going to give my take on the question whether the value premium has been disappearing. And then finally, I'm going to offer my thoughts about the challenges facing this literature, that is quantitative theories for the cross-section of returns. Economic model. So it's an industry equilibrium model, and it's partial equilibrium, but it's not the individual firm level model per se. Firms do interact with each other within a given industry. Okay, so firms are not independent of each other. A given firm is going to take into account other firms' impact on the output price into account when forming its own optimal decision rule. So this is the profit function, decreasing return to scale. Alpha is lower than 1. F is the fixed cost of production. So X is the log aggregate productivity. So this is the source of systematic risk. So there are many prior industry equilibrium models without aggregate shock. So in that case, because the economic questions were different, however, without the aggregate shock, all the firms in the economy will earn exactly the risk-free rate. So equity premium is going to be 0. So ZT is the firm-specific productivity process. So this is the source of firm heterogeneity, and later on, many other researchers have introduced different sources of firm heterogeneity, but productivity shock following the RBC literature is the first place to start. And this could be demand shocks as well. I'm agnostic about that. So it turns out in the model, because of decreasing return to scale, and capital is another source of firm heterogeneity. In other words, firms differ both in terms of their exogenous firm-specific productivity levels, as well as their endogenously evolving capital stock levels. Okay, so and this P is log output price, okay, which is going to be determined in industry equilibrium. Stochastic discount factor. So so I started out trying to solve a general equilibrium model, and turns out back in 2001, turns out too much for me to handle. And then this was the compromise, in a sense, an equilibrium balancing act between impact and the feasibility. At the time, it was not very clear how to address equity premium in a general equilibrium production economy. That issue we as field have only recently gained some traction. So nevertheless, this was the industry equilibrium model that I worked out in my thesis. That means exogenously specify the stochastic discount factor. So you can see the functional form imitates Campbell-Cochrane's external habit formulation. So instead of consumption, because we're not going to create a model, so instead of consumption, so I'm just going to have log aggregate productivity in the log pricing kernel. Okay, so that means interest rate and maximum Sharpe ratio are uniquely determined by the pricing kernel, and it's going to aid the calibration process later. So value maximization of firms. So all the firm level variables, all kinds of profitability, investment, risk, and expected returns, all these variables are going to be endogenously determined. So I'm going to solve all these endogenous key moments on the grid, on the state space. So industry demand function is given by this form. Y is total industry output. Eta is the inverse price elasticity of demand. So XT and ZT are two exogenous state variables. So PT, log output price, is the endogenous aggregate state variable, and KT is endogenous firm-specific state variable. So I'm gonna suppress the firm-specific subscript J to keep the notation parsimonious, but it should be understood that K and Z have a subscript J. They are firm-specific variables. So V is cum dividend firm value. Firms are going to choose optimal investment such that this cum dividend firm value is maximized. So current period dividend is given by output or revenue or sales or whatnot. So minus fixed cost of production. So there's some expenses, right? So this would be output minus revenue minus expenses. That would be your profits. So you use profits to invest and pay some adjustment costs, investment related costs, fairly standard in the investment literature. So, and whenever that's your free cash flow, whenever you have free cash flow, if it's positive, so I assume firms distribute the free cash flow back to shareholders. If it is negative, so that means shareholders are contributing external equity back inside the firm. So finally, so the second term in the objective function is the expected continuation value. So which is basically the next period firm value. So discounted using the pricing kernel, and you have to take a conditional expectation. So we have two exogenous stochastic states, and this double integral is basically conditional expectation, conditional on current level state variables. Okay, so this is the Bellman equation of optimality, and you can write it down using an infinite horizon problem. So firms value is basically present value of all future dividends, including current period, discounted by the pricing kernel. So this is the Bellman equation. Looks like a two period and makes the model computationally tractable. So it's going to be firms solve a value maximization problem subject to the capital accumulation rule, which says that next period capital equals current period capital net of depreciation. Delta is the rate of capital depreciation plus new capex, new investment. So that's the setup. So I'm going to follow Avon Albertly in modeling costly reversibility. In other words, capital adjustment cost function is asymmetric and quadratic functional form, just simplest to start. So asymmetric means that whenever firms are disinvest or investment is negative, and this parameter theta is going to be theta minus, and theta minus is going to be higher than theta plus. In other words, firms face higher costs, higher amount of adjustment costs when when cutting capital, when reducing capital, then expanding capital. So a graphical illustration is given as follows. You have investment rate on the horizontal axis. Vertical axis is adjustment cost. It's quadratic, and basically, and asymmetry means that the disinvestment costs or adjustment costs associated with disinvestment are gonna rise up on you pretty fast, way faster than the cost associated with the positive investment. Risk and expected return. So basically, if you go back to the value function at the optimum, and you can, if everything is solved optimally, and you can get rid of the max operator, and then you have V equals dividend plus EMV prime. Okay, so you have current period value equals cum dividend value equals dividend plus conditional expectation of pricing kernel times next period value. Okay, I'm gonna shift dividend to the left-hand side and then divide both sides by V minus D, and then you get the, EMR equals 1. Okay, so conditional expectation of pricing kernel times return equals 1. And that's oftentimes called the fundamental equation of asset pricing. The details are in the paper, so I'm skipping a few steps here. Sorry, I have to read the equations out loud in a presentation, which is uncalled for. So bottom line is that the risk and expected return in the model satisfy this equation. Is linear. Well, it's actually non-linear because beta is amount of risk times the price of risk is a product. It's not exactly linear. It's a non-linear model. It's a conditional cap-band type of model. So, and the stock return is basically given by this form. Keep in mind the V is cum dividend firm value. So V minus D is X dividend, and numerator is X dividend firm value plus dividend. So this is actually a fairly standard definition of stock return. Okay, and that's dividends, and that's so basically starting from the fundamental equation of asset pricing using definition of covariance, and you can write this down as a beta pricing form, is always very standard techniques from the consumption cap band literature. All right, so aggregation, because individual firms, they live within the same industry, and the output price is going to be determined through industry demand function. So firms, when making their individual decisions, are gonna worry about what the output price is gonna be next period. You're gonna form your conditional expectation based on that. Actually, that's another transition matrix. Rigorously speaking, you have to take expectation on. It's endogenous, so I'm not writing it down explicitly. Right, so, and for firms to forecast next period output price, and the firms need to know the aggregate industry output today, and that involves aggregation, and that's the challenging part of modeling the whole cross-sectional distribution endogenously. And you can see Joao's influence on my work very clearly, and this modeling technique is straight from Gomez 2001 AER paper, which is his job market paper out of Rochester Econ. The law of motion for the cross-sectional distribution of firms, call it the mu-T. It looks technical, but all that is saying, it's a measurable theta is some measurable set. Is basically so it's some set that consists of two dimensions, capital and the firm's specific productivity. It looks technical, but all that is saying is that it's all driven by the aggregate investment policy. All right. Once you have aggregate investment policy, you can figure out the next period capital. In fact, investment this period and the KT plus 1, they are equivalent out of the capital accumulation equation. Okay. So, and you need to solve for the law of motion in equilibrium. and the industry output after you have solved for the law of motion in equilibrium, and at any point of time, aggregate industry output, you basically add up all individual firms' output. And that's given by this form. Double integral again, because K and the Z are the two dimensions in the cross-section of this bivariate firm-specific bivariate cross-sectional distribution. Right. So recursive competitive equilibrium is characterized by log output price. This definition, Marion Prescott, 1980. Style definition, econometric paper. So optimal investment rule as well as a value function. Law of motion as well for the distribution, such that optimal investment, optimal value function solve the firm's problem. And consistency means everything has to add up aggregation-wise. The aggregate output should be consistent with the production of all firms in the industry. And the law of motion for the distribution is consistent with the optimal decisions of firms, which means this equation holds. And of course, at the end of the day, everything is put on a computer. So product market clearing, which means output price is determined by the inverse, by the industry demand function, and ADA is the inverse price elasticity. So solving the law of motion at the time took a while. I was working on a 1 gigahertz CPU, so it took a while. But you gotta have a sense of humor about these things. All right, so approximate aggregation, Croissant-Smith, and output price depends on the firm distribution. So I'm gonna assume the firm distribution, even though it's two dimensions, K and Z, right? But in terms of moments, it's an infinite number of moments. It depends on the mean, volatility, and the skewness, kurtosis, even fifth order, sixth order, and different levels of tail probabilities, and you can go on and go on and go on, right? So the basic insight is infinite dimensional state space. The insight of Croissant-Smith 1998 paper is that you can approximate that infinite dimensional state space with the finite. By finite, I mean very few number of moments. Otherwise, if it's not very few, you're dealing with the curse of dimensionality. So it takes a little bit luck that I settled with the industry equilibrium. That it turns out that the log output price is approximately linear, and then that helps a lot, especially this AR1 term helped a tremendous amount. So I was relying on my memory now. So I got at least spent like 6-8 months banging my head on the wall. I started out with the power utility, general equilibrium. I started out just like Croissant-Smith using aggregate capital. And the law of motion, the R square it's persistently in the lower 70s. So after being stuck for a few months, and then I finally saw the light and decided to compromise, and that compromise is this industry equilibrium model. So, and then I solved firm's problem using value function iteration. It's globally nonlinear method and fairly reliable. It is a contraction mapping for the value function iteration part, not the outer loop with the Croissant-Smith part. And there you really need to be lucky for the thing to converge. But the value function iteration, the inner loop, that's a contraction mapping. It always converges. So solve the firm's problem and then use the optimal decision rule to simulate the industry 5,000 firms for 12,000 monthly periods. Use the stationary distribution, meaning you discard the first 2,000 and use the remaining 10,000 as the stationary distribution, and then fit this log linear law of motion on the simulated data out of this 10,000 monthly periods to update the Croissant-Smith coefficients. I have A4 here as well. So A1, A2, A3, and A4. So it's a typo is missing here. And then you check the convergence. So for the A coefficients, if not, you go back to, you update the coefficients and you get back to step 2, you keep iterating. So as noted, the outer loop is not exactly a contraction mapping, and in practice, if the specification works, it will converge, okay? So it takes quite a bit of luck. And then if the coefficients converged, and then you need to check the R square for the log linear law of motion, basically. So what's the R square in particular? If the R square is low, so in practice, for example, is below 99%, and then you need to cook up, you need to think harder about the alternative specification, and until the whole thing works. So this is the fun part of a Croissant-Smith. So it's not exactly one would characterize as a low-hanging fruit in terms of research projects. So this is technically demanding. All right, so let's look at the results. So in terms of calibration, so at the time, I was among the early ones to calibrate this class of models, and a couple of prior studies use real options model, so the calibration is quite a bit different. So, and this was largely the first RBC type of model for the cross-section. So, so you see now, this is 16, 15 years later. If I were to do it again, I would do a few things differently. So in particular, this alpha, at the time I call it the capital shear, but it's actually not capital shear. So this alpha is the curvature parameter. So it's a function of capital shear. Actually, later on, researchers like Hennessy and Whited have estimated this curvature parameter to be in the range of 0.65, 0.7 is not exactly 0.3. And moreover, this aggregate the conditional volatility for the aggregate shock. So I was trying to match the 0.95 for persistence and 0.007 for quarterly estimates, including the Prescott 95, but it turns out my conversion is wrong. So later on, I fix it, but that has to be several years later. But the bottom line is that the basic causal mechanism is actually quite reliable. So in particular, if I use the correct conversion, so this sigma x is actually bigger than the value I used in my 2005 article. In this article, it turns out the firm level dispersion is going to be wider, and you don't have to rely on more on other parameters to generate the value premium. All right. So the group 2 parameters, these 3 parameters, so they pin down the average risk-free rate, the average Sharpe ratio, market Sharpe ratio, as well as the volatility for the risk-free rate. So that's basically not a whole lot of or not much degree of freedom in these parameter values. So, and delta is basically monthly depreciation rate. I'm using economic depreciation rate as most of the other macro type of RBC type of studies. So rho x is, as noted, is a fairly standard value. So not a whole lot of room to maneuver there. So group 3 is, well, that some degrees of freedom lie. So F is the fixed cost of production. So it goes with the alpha parameter, because I was using a relatively low value for the curvature parameter. So I ended up using, so meaning the monopoly kind of degree of freedom, decreasing return to scale is a little bit strong. So it turns out that you can interpret that as a bit of a monopoly power. So I have to use a higher value for fixed point of production to bring market to book on average in line with the data. So if the curvature parameter is high, like 0.7, 0.65, this F parameter doesn't have to be that high because the decreasing return to scale, the degree is not that strong, or monopoly profit is not that big. So rho z and sigma z is determining the amount of cross-sectional dispersion. So and then so it turns out that this rho z parameter later on, Shlala Tessel has a paper with co-author in a management science paper. They estimated firm-specific firm productivity. It turns out the rho z is precisely 0.97. So it was a little bit of a dumb luck on my side. So, but again, you can probably vary the parameter value a little bit. I don't feel that the basic economic, the causal mechanism will be much affected. So sigma plus is the adjustment cost parameter when investment is positive. And this parameter, this ratio of the two parameter values for adjustment costs are basically the asymmetry. Okay. We don't have a whole lot of empirical guidance. The direct empirical estimates are scarce. We're actually, now the literature is looking at these issues now. So after so long, right? So after we calibrate the parameters, the ideal calibration, calibration study, the ideal is that you wanna execute everything carefully. You wanna tie your hands as much as possible. First of all, you use whatever available empirical estimates available, and then you tie your hands. You pin down the key parameters using whatever moments that are not that controversial to begin with. And then you choose the final group of parameter values to hit your targeted moments, okay? And then you report extensive set of comparative statics. And that's how we try to execute our calibration quantitative theory study carefully. So basic moments averaged. So at the time, the computer power was, pretty expensive. So at the time, I only implemented 1,000 simulations, and nowadays we routinely implement 10,000 simulations. So we have made some progress. So after 15 years, we go from 100 to 10,000. So that's progress. Each with 5,000 firms and 900 periods. So a broad an array, a long list of aggregate moments. So these are not the key moments I was aiming at in this paper, but the fact that these aggregate moments look roughly in line with the data, and the idea is that, look, we're roughly in the ballpark. So the model laboratory is reasonable, and that's the basic idea. So here's the key table: properties of portfolios sorted on book to market. So HML is the value factor from 2x3 sorts. So low to high. So this is deciles. Okay. So so in the data. So this is from the Ken French's data library. At the time, it was the only option. Not anymore. Now we have globalq.org. So. And the sample is from 1926 to early 2000s. I'm relying on my memory now, which is unreliable. So 2001, 2002, the detail is in the paper. So value premium at the time is doing pretty well, 4.7% per annum. Beta, even in the long sample, including the Great Depression at the time, so 0.14. And then the high minus low in terms of decile is about the 6% per year. So in the model, I'm generating 4.9% for the value premium. So the beta, the unconditional CAPM beta, unconditional market beta for the value premium in the model, I'm having 0.43, which is substantially higher than that in the data. And this estimate has generated the large, this is a weakness, let me make it very clear. And the large literature, subsequent literature has been generated, has risen in order to resolve this issue, okay? Or the failure of the unconditional CAPM in explaining the value premiums, because in this model, in my model, and my model fails to explain that. But at the time, everybody was trying to generate a positive value premium. So the CAPM alpha was not even on my radar at the time. So this is the benchmark calibration with the asymmetry, asymmetry, and the time varying price of risk. Model 1 is symmetry and the constant price of risk. And model 2 is asymmetry and the constant price of risk. Okay, so you can see that without time varying price of risk, although with asymmetry, the value premium is 2.5%. If you further get rid of asymmetry, the value premium drops further, 2.2%. So the next table, I went ahead and did a whole bunch of alternative parameter values for model 1. So, you know, so it's probably, so because at the time I was trying to show that asymmetry and the combination of asymmetry, custody reversibility, and the counter-cyclical price of risk are necessary conditions. So why would I do that? So looking back, it was probably forcing it a little bit too much. So I think showing asymmetry, asymmetry, and the counter-cyclical price of risk are sufficient conditions, and that's probably good enough. But nevertheless, at the time, I was going for necessary conditions. Basically, I worked out different parameter values. So low productivity, low volatility, high volatility, and fast adjustment, basically low adjustment cost with the positive investment, and the high adjustment cost, low fixed cost of production, high fixed cost of production, low persistence, high persistence, and then after reporting that the value premium increases with the volatility, firm-specific volatility. This is not surprising because higher conditional volatility for firm-specific shock, the more dispersed the firm level distribution is going to be, and of course, the value premium is going to be higher. So higher adjustment cost, Urban said, higher risk, and of course, we're going to see a higher value premium. And so this implements that in the cross-section, and this echoes Urban's Yearman's insight in his 98 article on at the aggregate level. So higher fixed cost of production, this means higher operating leverage. So in the model, you're gonna see higher value premium, and this echoes Carlson Fisher, Gemarino's 2004. So it's a contemporaneous article to my value premium paper. So, and this is mainly their central contribution. Let's give credit where credit is due. So persistence, firm-specific persistence, or persistence in the firm-specific productivity, rho Z works pretty much like sigma Z, all right? So it turns out the higher persistence, stronger dispersion, because the unconditional productivity is going to be higher, and therefore higher value premium. So in the last little bit column, so I pull together higher volatility, slower adjustment, and the higher profitability all together So, and then it turns out the value premium is 3.1%. I said this is not enough to generate the value premium realistic level as we see in the data. Therefore, I conclude asymmetry and the countercyclical price of risk, the combination of those two elements is necessary condition. So it was, you know, so it's while I was young. So bottom line is that again, nowadays with a little bit more experience in terms of writing, I would just simply go for showing asymmetry and the countercyclical price of risk are sufficient conditions, and then conduct comparative statics around the benchmark calibration. All right. So as opposed to doing comparative statics around the surrounding model one and then trying to argue asymmetry and the countercyclical price of risk are necessary. That's probably a little bit too strong. All right. So let's look at the quality of the approximate aggregation. Right. A1, A2, A3, A4. So R square is 9994, not as many nines after the decimal as Grosal-Smith, but in a model with a strong risk premium, right? A huge amount of risk, aggregate shock, this is probably reasonable. You know, I felt comfortable with it. And you can see the actual output price plotted against predicted output price. This is pretty much 45-degree lines. So not exact, you can see small wiggle here and there, but it's probably okay. In terms of excess demand in the market clearing condition, so on the right panel, I'm plotting excess demand as a fraction of total output in terms of percentage fraction. All right, so we're looking at 0.15% as the maximum. So that magnitude, most of the time, is actually quite close to zero. So we say this equilibrium this aggregation is approximately holding up pretty well. All right, so let me dig into the causal mechanism. So far, I've argued that the model fits the average value premium level pretty well. At the time, I didn't realize, and of course, later on, other researchers have pointed out, and then I looked at the evidence, look at the simulation data, I said, right, you are right, this is a weakness of the model. And then later on, we acknowledged the weakness of this model and also try to fix this anomaly vis-a-vis this framework. As well, explain the failure of the CAPM. So the failure of the CAPM is being explained the value premium is like anomaly in this framework. So which is cool. Anomalies everywhere. So anomalies are good. They keep us employed. Causal mechanism. So it turns out that in the model, so value firms are less profitable than growth firms. So because the exogenous source of firm heterogeneity is firm-specific productivity. So in this experiment, I'm following Farmer French, 1995. So I've been studying a lot of Farmer French papers. So I was following their measure of profitability, change of capital stock plus dividend scaled by lagged capital stock. So this little bit of a clean surplus assumption in accounting buried in there. Again, only 100 artificial samples. Computers back then were kind of slow. So as in the data documented in their 1995 Journal Finance paper, growth firms are more profitable than value firms. Year zero this is an event study. Year zero is the portfolio formation year. So growth is 30%, 30, 40, 30 cutoff. This is 30% low booked market. And you see that growth firms are more profitable than value firms for 5 years before and 5 years after the portfolio formation. So basically, in each of the 100 artificial sample, I implement exactly the Farmer French procedure, okay? And then I take the cross simulation average across all 100 artificial samples and report the cross simulation averaged results. And this is the result. In a time series, so growth firms, again, cross simulation average, growth firms are more profitable than value firms. Well, if that's the case, growth firms are more profitable than value firms. That means growth firms are going to invest more than value firms, right? So again, across 100 simulation samples. So on these two panels, on the right panel, so I'm plotting adjustment cost, the H function, the asymmetric adjustment cost, the figure illustration I showed you earlier. So I'm plotting that adjustment cost against the investment rate, right, in the model simulations for each artificial panel, and then take the average, and then put everything together. So we see that growth firms indeed invest more than value firms in good times, and in bad times, value firms disinvest more than growth firms. In fact, growth firms tend to invest still, even in bad times. Some growth firms are down here, but some growth firms, especially with good specific shocks, firm-specific shocks, they're actually investing. Okay, good times are defined as one unconditional standard deviation above the mean of aggregate shock. Bad times are defined as one unconditional standard deviation below the below the long-term mean of the aggregate shock X bar. Okay, the details are in the paper. Now I can argue that precisely because value firms want to disinvest, want to cut the capital more, they are going to be stuck with more unproductive capital because they run up against steeper adjustment costs pretty fast. Okay, so they are less flexible. They are stuck with more unproductive capital, and therefore their dividends are going to, their cash flows, free cash flows, net payouts are going to fall more in the presence of economic downfall. Okay, and that's the endogenous amount of risk. And indeed, that's what we see. That's what I see in the model. So I argue risk, the causal mechanism, risk as inflexibility. Value is riskier than growth in bad times. This is expected excess return, risk premium, and you could plot the risk. It's going to be the same thing, all right? Just the magnitude is going to be different. And you can scale it with the price of risk lambda, and that's just going to be the true beta. The pattern is going to be identical. So expected risk premium. So you see in the benchmark model, benchmark calibration, value is riskier than growth in bad times due to asymmetry. So this is a model, let's see. So I'm fixing this on the state space. Nowadays, if I want to do it again, I'll probably do out of doing a scatter plot out of simulations. So, but back then I was just plotting everything and do a COVID map, heat map out of scatter plots. So as we did in our forthcoming GFE article, searching for the equity premium, but at the time I was just working on the state space, on the grid directly, while fixing the lock output price and lock capital at its long-term average level, and therefore I get to plot. It's a 2D graph. I tried to plot the 3D, and then it looks ugly, so I just stick with 2D graph. And then again, nowadays I would do a scatter plot. So now we're stuck with the published paper. So it's expected risk premium plotted against aggregate log productivity. So you see, this is a high minus low. So value is the value minus growth risk blows up in bad times. Okay, so if I remove time varying price of risk, it drops. It's still the same pattern qualitatively, but quantitatively it drops. If I once again remove asymmetry, cause the reversibility, it drops further, although value is still riskier than growth, but the magnitude is small. Bottom line is that the combination of costly reversibility and time varying price of risk drives up value minus growth risk in bad times, especially in bad times. So that's the left panel. In the right panel, I have book to market. So this is the value minus growth in terms of book to market, the valuation spread. So again, so it turns out in this case, model 1, model 2 are not that different. And the combination of value minus growth, combination of asymmetry and counter-cyclical price of risk really drives up the valuation spread in bad times. And you can see that if you regress future value minus growth returns on the valuation spread, you get to see some style timing, basically predictive regressions. So, and those are the secondary, auxiliary, supplementary results reported in the paper as well. And I don't have a slide in the presentation to keep the presentation relatively short. So bottom line is that this is a novel prediction, actually consistent with the prior evidence. It's not exactly novel in that regard, but at least it's a novel vis-a-vis the theoretical literature. So bottom line is that if you perform a predictive regression of value premium returns on the valuation spread, you're gonna obtain a positive slope. In other words, high valuation spread, it's gonna forecast high value premium going forward. All right, so, and that ends my discussion for the causal mechanism for why value, for underlying the value premium based on a combination of costly reversibility and the counter-cyclical price of risk. And this mechanism initially has met with quite a bit of resistance. So, and I remember when I was first going around presenting this paper and using the figure, asymmetric adjustment costs and talk about the value is riskier than growth, and that actually didn't go very well in some interview rooms. So, but that's all ancient history. So the reason for the initial resistance is really stemming from a very influential article by Lakonchak, Schleifer, Vishny, 1994. So they looked at value versus growth risks. They conclude that value is actually safer than growth in bad times. So they have a few quotes from their paper they argue to be fundamentally riskier. Value stocks must underperform with some frequency, and particularly in bad times when the marginal utility is high. So then they argue, they looked at the relative performance of value versus growth, including extreme bad times, extreme down markets, and economic recessions. They argue that they couldn't find, they end up finding no evidence that value strategies are fundamentally riskier, and then they end up concluding the value premium is driven by investor overreaction. So we looked at we've been hearing about people pointing out, look, you need to take a look at Lakonchak, Schleifer, Vishny, is the critique is all fair and square. And we did look at it in Petkova and Zhang paper, that we looked at the evidence, we addressed their critique, and that's the earlier figure I presented, the figure 13.3 in Bodick and Marcus, 12th edition. It turns out the Lakonchak, Schleifer, Vishny define good versus bad times based on realized, exposed, past realized market returns. Whereas in terms of, whereas we follow the business cycle literature in defining good versus bad times based on predictors like term premium, default premium, real interest rate, and dividend yield, we form expected market risk premium. All right, and we define if that expected the equity premium extremely high, we call that bad times. That's when investors are nervous. Amount of risk in the economy is high, and that's what we call bad times. So it turns out the Lacan structure definition is grouping, sorting for economic states is imprecise. If anything, the timing is not exactly lined up, so they turned out to go slightly in the opposite way. So bottom line is that I'm not gonna rehash all the details in Petkov and Zhang paper. So bottom line is that if you are interested, dig into some of the details. Bottom line is that my sense is that value is probably riskier than growth, but then later on, my view has more evolved in the sense that I'm downplaying the evidence on risk because betas are so mismeasured, right? I don't feel like we should hang our heads on some highly mismeasured betas. Right? Even though betas command a dominant role in the consumption CAPM framework, and in my view, we should just do fundamental analysis. Like we should look at the firm level variables, okay, and we should do micro-based investment model. But that's a debate for another day. Okay, so I'm patiently taking my time to structure my arguments, and hopefully one of these days I will get them done. All right, so let's look at some of the subsequent literature. So as noted earlier, it turns out the failure of the CAPM is an anomaly that my 2005 model cannot explain. Right, so the beta is 0.43, whereas for HML, whereas in the data is only 0.14. And readers quickly point that out, and in the subsequent literature that we acknowledge the weakness and then try to do something about it. So this is the Lin and Zhang 2013 article at Journal of Monetary Economics. So we confirm that the 2005 model indeed fails to explain the failure of the CAPM explaining the value premium. So this time around, the model is much simpler. So I got rid of the industry equilibrium, just work with the partial equilibrium individual firm model, still decreasing return to scale, aggregate productivity, firm-specific productivity, exactly the same pricing kernel, capital accumulation, asymmetric adjustment cost. In addition to the quadratic term, we added a little bit of linear costs, but that's not really important. It turns out that if you get rid of A minus A plus, the basic results will hold. So cum dividend firm value, the calibration strategy for the pricing kernel parameters is identical. So see, later on, I came across this wonderful book by Here and Mostner, 2009, Dynamic General Equilibrium Modeling, extremely useful book. So in the appendix for one of his chapters, so I came across the equation that that's the conversion from quarterly conditional volatility to monthly for an AR1 process. The conversion formula for persistence is the same as before. It turns out I converted that persistent parameter correct, but I didn't do it correctly in my 2005 paper, and now we fixed it. So, and this is the equation. So adjustment cost, and also now we're following Henderson-Whited. This is 2005 and 2007. So we're using the curvature parameter in the production function to be about 0.7. So we fixed that as well. And because that curvature parameter is higher, and we get to use a bit lower, quite a bit lower fixed cost of production. So bottom line is that the causal mechanism remains quantitatively important, right? So the failure of the CAPM is a valid and important critique. So, so this is the data, book to market deciles from Ken French's data library. So the paper was written, this paper was, the Ling and Zhang paper was published in 2013. And back then, that data library was the only option. So the sample is from 65 to 2010. So value premium is high minus low book to market decile, 55%, 0.55% per month. CAPM fails, alpha 56 basis points per month. The t-value being 2.4. Beta is basically 0. Value is not riskier than growth. In this sample, and t-value is 0. Basically, CAPM doesn't explain anything for the post-compute stat sample for book to market. That's the evidence. That's the data. Although I have been saying, no, you need to look at the longer sample evidence. So I've been emphasizing the longer sample. So if you go back again from Ken French's data library, going back to January 27, so the value premium doesn't really change, 53 basis points per month. But alpha drops more than half, 25 basis points per month, and insignificant. And look at the beta. Beta is 0.45 now. So remember, I reported in my thesis 0.43. So in this score, I was actually not that far off. So, but the bottom line is that if you run the simulations, so using the Ling and Zhang model, which is a simplified model for Zhang, and you simulate the model fitting with each sample matching the length for CompuStat, post-CompuStat sample, you match the mean value premium, but alpha is insignificant, right? So in particular, the 56 basis points estimate, it's close to the upper bound of the 95 confidence interval. Now, I'm not going to claim that as a success for the model is because it's too darn weak, right? So I'm fairly okay with admitting I'm perfectly fine. If anything, I embrace anomalies, weaknesses in my own body of work because that creates research opportunities to keep myself employed. And look at the beta. The beta is basically 0 in the post-CompuStat sample, but that lies outside the 95% confidence interval. Bottom line is that the baseline investment model in Zhang 2005 fails to explain the failure of the CAPM, unconditional CAPM in explaining the value premium. Okay, and that's the verdict from the Ling and Zhang paper. All right, so so now let me get to the issue about the recent performance. So recently, if you are following the news in factor investing, there's been a lot of discussion about the value premium disappointing performance in recent years. So now is 2020, 2021, the sample ends in December 2020. We have a better data library, in my opinion. And I'm open to debate, of course. You are free to use whichever data library you prefer, but we prefer Global Q. Make no mistake about that. So we're using book to market. The sample 67 to 2020, the value premium is only 30 basis points per month now. Okay, insignificant, although the CAPM is still not doing a whole lot with the weekly negative beta very close to 0, weekly negative, and CAPM alpha is even 2 basis points higher than the average return. Okay, so CAPM still fails, but looks like we have a bigger problem that the value premium is insignificant. Right, so my take is that so this weaker performance, 30 basis points, has a lot to do with book equity and not being informative. as an accounting variable. So this echoes a long stream of influential literature by Baruch Lev. Fascinating work. I really love it. So I've been consuming intellectually his intellectual work avidly. So I've learned much from his writings. So that's my sense. So on this slide, if you do not use accounting book equity, if you instead using operating cash flow, so here I'm following the operating cash flow definition from Raybo and co-authors 2016 JFE article. So cash flow to market, high minus low. Now we're looking at 80 basis points per month now. Gigantic t-value, 4.2. CAPM still fails and fails even more relative to book to market. So minus 0.18 and significant t-value. And CAPM alpha is 11 basis points higher than the average value premium if you measure the value metric as operating cash flow to market. So why is that? Why would the cash flow perform better than book equity? So I do agree with the Lev that book to market, that because of intangible investments and book equity is probably losing quite a bit of information content. So on the other hand, I'm also persuaded by Penman and others, especially Steve's 2009 article, that in which he argues that operating cash flow is better than book equity in capturing the impact of intangible investments. So take Coca-Cola, for example. So you don't see brand capital for Coke on Coke's balance sheet. On the other hand, you can ascertain, that's Penman's wording, you can ascertain the value of brand capital from Coca-Cola's operating cash flow. The cash flow keeps coming in because of the brand capital, right? And you can figure out, you can capture indirectly the value, the impact of intangible capital out of operating cash flow. Now, operating cash flow is simple to measure and doesn't involve like impairment or amortization and the uncertainty that the Penman was complaining about. Right, that's a separate issue, right? Whether you want to put the intangible capital on the balance sheet, put it on the book, and then you have to amortize it. You have to impair it, set up an ex-ante amortization and the impairment rule under uncertainty. You're gonna give managers lots of degrees of freedom to do earnings management, and then that may contaminate the quality of earnings. So I'm bit persuaded. I'm actually persuaded in that dimension. So maybe accounting standard setters need to be cautious in that regard. So whereas on the other hand, that doesn't stop data analysts like empiricists like myself and to do different adjustment for earnings. In this case, I'm very much fond of operating cash flow because it's simple to use. It captures some of the intangibles impact, in particular the R&D, for example, is captured by operating cash flow. All right, so we can still talk about the recent performance. Okay, so all right, let's wrap up a little bit. Operating cash flow, in my view, mitigates a lot of the problems for book equity's failure in capturing intangibles. On the other hand, we can still look at the recent performance. Book to market, this is a monthly percent. Again, this is from our global Q data set. Book to market deciles, not that different from a French version, but we do not include financial firms in our sample. And the firms with negative book equity, but I don't think that it's quite. I don't think sample selection is different. It's impactful in the basic results. So this year, book to market, you see high minus low. This is 3.7%. This is per month. Annualize it, you are looking at a gigantic number. Okay, this is 3.7% per month. It's a huge number. And especially it's mostly deriving from the growth, the low end. The growth firms looks like doing pretty well. Last 3 years, 2.7% per month, pretty awful as well. Last 5 years, 1.5%. Last 10 years, 1% per month. So all these are pretty bad numbers. So if you look at operating cash flow to market, better, but still awful. 3.7 versus 3.7, that doesn't change. So 2.7 past 3 years versus 2 on the performance, 1.6 right here versus like 1, and 1% per month versus 0.5. So bottom line is that, so even if you use operating cash flow to market, it looks like the value premium is still suffering in recent years. So there may be, my take is that now I'm speculating now. This is not a rigorous scientific study and all, but my sense is that there may be a bit of a cyclicality going on. So early on in my thesis, I did show that the expected value premium is counter-cyclical. So if the causal mechanism I came up with in my thesis is correct, going forward, my prediction is that this number is gonna, this negative performance is gonna revert. And we'll see whether that prediction pans out or not. All right, so finally, let me conclude. Let me take stock, do a summary, and talk about open challenges facing this literature. So in terms of methodology, the value premium paper is the first paper, in my opinion, that writes down a real business cycle style model of the cross section. So there were a couple of real options models in prior models, but it's quite a bit different from the RBC modeling. The RBC modeling, the real options model, projects level risk is exogenous, which is something I want to avoid because I want to derive risk and expect returns completely endogenously, right? So, so tastes and technologies, those are exogenous ingredient. Those are the exogenous forces in the RBC model. So on the other hand, as heavily influenced as I was by the RBC line of work at the time, so applying the RBC line of work in the cross-section of asset pricing literature takes a little bit of adaptation, okay? So the RBC literature always works with general equilibrium because the economic question is macroeconomic questions. So at the time, I started with general equilibrium, okay? So I've grown more agnostic about it because as important as capital markets or financial markets, we are working on a sector. We're not working on a whole economy, right? So capital markets are big, important, albeit, but it's a sector. Okay, it's just one part of the overall economy. So we gain quite a bit of insight from industry equilibrium or partial equilibrium as well. And later on, I did manage to extend the model into general equilibrium, which I will do in a subsequent presentation. And that's the 2019 GFE article, 2005 to 2019. It took 14 years for me to take this step. So general equilibrium, I'm not taking it religiously. It involves the equity premium puzzle that you have to handle in a general equilibrium production economy. So it takes, right? You have to balance between impact and feasibility. We all want to solve the world hunger, but at the same time, we need to do things one step at a time. So on the other hand, because I was dealing with asset prices, so I was born a nonlinear guy in a sense that so log linearization has always made me nervous. So especially I was working, the cross-section of returns, we deal with firm level variables. At the firm level, shocks are pretty big. Log linearization just won't cut it. So, and of course, equity premium, risk premium is a second, and time variant risk premium, it's higher moments, okay? So I started out doing global nonlinear algorithm from day one, from intellectual birth. So took a lot of time, but nevertheless, so it's worthwhile. So at the same time, so this quantitative theory line of work also departs from mainstream asset pricing theory. Now I should say the quantitative theories, in my view, has become mainstream asset pricing theory, but the analytically oriented continuous time closed form solution, so still is currently still quite influential. At the time, that's mostly the metric of high quality research. So so in a sense, we have to overcome that the resistance implicit most of the time as well. So but I'm happy to report the quantitative theories style work is now mainstream asset pricing theory. On the other hand, and we're still, again, in terms of research methodology, I'm quite sympathetic to this critique. Okay, to many empiricists, calibration is like a black box, a black art. Okay, at least a black box, and this criticism is well taken. So having spent time writing the Q factor paper, I can appreciate the seriousness, hard-nosed empirical work, the attitude towards research embraced by many empiricists, all of whom I respect highly and I admire. So bottom line is that calibration, the quantitative model is a black box, right? So, but we can do quite a bit in terms of bringing out the transparency. So nowadays, the model, the dynamic investment model I was working with nowadays is, I would say, fairly standard. If you get rid of the industry equilibrium component, the partial equilibrium dynamic investment model is actually, I would say, simple. So, and the algorithm, we have accumulated a lot of experience dealing with the computational algorithm in terms of writing, and one can produce quite a bit of intermediate results. Now you don't want to overwhelm the reader by providing a data dump, but that's what the online appendix is for. But you can indeed provide a lot of intermediate results to persuade the reader. Because you don't want to be vague about the key steps. You want to be as concrete as possible, right? And I read somewhere, being concrete builds credibility because you want to guide the reader through your steps. Comparative statics, and make the intuition as transparent as possible. Replication, and having written replicating anomalies paper, so my sense is that in the quantitative theory literature, replication may be even more a problem than anomalies, because the costs of replicating a quantitative theory paper is pretty high. Okay, you wanna do code sharing, and for my thesis, I've been posting my Fortran 90 and the MATLAB codes since 2004. When Rick Green sent me the acceptance right after Rick sent me the acceptance letter, very grateful to Rick and miss him dearly. So, and close match with data as well, right? So, and this is a step that we have only recently started to think very carefully, also from calibration to SMM, simulated method of moments. So that requires us to simplify the model greatly. You cannot estimate SMM. You cannot SMM a general equilibrium model. It takes 3 days to solve the model once, and then maybe we have to wait for another 15 years with the quantum computing technology, maybe. So, but we can build a data infrastructure. So closer match with data. So a lot of the theoretical constructs do not actually match directly with the CompuStat financial accounting data. One example is accounting versus economic depreciation rates. Okay, so that requires us to build the data infrastructure. Now it's probably infeasible to build to rebuild the financial accounting system for the CompuStat data set, but we can build part of the system that we work with using economic accounting, using national accounting. That's an item on our radar right now. Right. So the methodology, bottom line is that the RBC quantitative research methodology, I'm happy to report, has become mainstream. So cultural change is slow but steady. 15 years, we have come a long way. So I also, in my view, in terms of substance, in my opinion, the business cycle analysis of risk and risk premiums, the causal mechanism based on costly reversibility and the time varying price of risk, the more generally, the business cycle analysis of risk and risk premiums has withstood the test of time, despite rounds and rounds of scrutiny. So, and we can debate about it, but in my view, right? So at the end of the day, the business cycle risk, business cycle fluctuations, that's the source for equity premium at the aggregate level, right? So what I was showing is that in the cross section, that's the major source of risk for the value premium. So just like a TFP shock or productivity shock, and you can be agnostic about it, a solar residual, and you may capture some government shocks, spending shocks, or demand shocks or whatnot. But the source of business cycle risk is a fundamental source of risk for the cross-section of returns. I think that mechanism, that causal mechanism, has withstood the test of time. The major challenge, in my view, is that, well, so despite the positive value and the investment premiums, later on we verified we have investment premiums in the model as well. So not reported in my original the 2005 article. Back then, I didn't know that the investment factor was a big deal. I only discovered it later on. So, however, the profitability and the momentum premiums are actually negative in the model. So again, we discovered that this later on as well. So, and in particular, in my thesis, profitability and the investment actually tied up together too closely, a little bit too close. So I'm aware that the many different teams of authors are looking at this issue. So I'm very impressed by Jing Li's management science article. So, and we're building on his mechanism, and a shout out to Jing as well. So we asked for his codes. I sent him an email. He responded within 12 hours, sending me all his Fortran 90 programs that help us with the replication process. So, and that's certainly good practice. So that's all I have prepared for this presentation. So thank you very much.